Are you ready to lose 40% of your money? That probably isn't the best way to become a millionaire, but it is possibly what is about to happen to a lot of people. Over the last few years, you've probably seen countless videos extolling the virtues of income-generating assets and passive earnings. One of the favored methods the financial influencers tout is to passively invest in index funds. Advice originally given by Warren Buffett, and even spoken about in videos on this channel. Well, I'm afraid I may have some bad news because possibly investing in an index fund could wipe out a majority of your capital. This is all due to the way index fund allocations are calculated. If you were to invest in an S&P 500 fund, your capital would be allocated between the 500 constituent companies, but not equally so. You see, the index is weighted. That means you would have a greater allocation to larger companies such as Apple, Microsoft, and Amazon, but proportionally less in smaller companies such as Fox News, Walgreens Boots, and Hasbro. This isn't necessarily a problem in a well-functioning market, where the difference between the largest and smallest company is modest. However, when you have extreme concentration in a small number of companies, there can potentially be very extreme concentration, and therefore volatility risk. And right now, there is a super high concentration in the S&P 500 index. Data from the Dow Jones Indices, which utilizes the Herfindahl-Hirschman Index, highlights the scale of the problem. This chart plots the HAHI index from 1990 right up until 2020, when that thing happened that we still don't talk about. In a perfectly distributed market, where each of the 500 individual companies had an equal weight, the index would read 20, the lowest possible score, showing an absence of concentration risk. You can see that there are peaks and troughs throughout this time period, but the average remains fairly constant at about 75, suggesting some small concentration, but nothing to cause alarm. In the run-up to the dot-com bubble, the index topped out at 123. This indicated a significant concentration of value in a small number of very highly priced companies. There was obviously the subsequent correction, when the bubble burst, and the index returns to more normal levels. However, let's now add additional data to the chart, bringing us up to August 2020. This was the height of lockdown, where technology companies were asserting ever greater dominance over our lives and reaping huge profits for doing so. The HAHI index smashed the previous all-time high and recorded a score of 159, indicating extreme concentration. However, despite a modest reversion, the index has continued to march ever upward. The most recent data, taking us up to the end of 2024, shows the HAHI is now 207, the highest level ever recorded, and almost double that of the dot-com bubble. This huge concentration of value is due to just 7 of the most valuable companies on Earth. You may have heard of the Magnificent Seven. No, not a spaghetti western. In this context, the Magnificent Seven is the name given to the largest 7 technology stocks which have come to dominate the index. They include Apple, Nvidia, Microsoft, Amazon, Google, Tesla, and Meta. Collectively, these 7 companies account for approximately 40% of the total market capitalization of the S&P 500 index. And all being well, that's not a problem. However, should there be a correction in the technology sector, which we have seen before, many times, then your passive, low-risk index fund could be in line for a very nasty correction. The question you may be pondering is, how likely is a correction? Well, all of these companies are profitable to a greater or lesser extent and are well run. However, they also, on average, enjoy very high price-to-earnings ratios, which isn't a problem assuming there are still large markets into which these companies may grow. However, if the market recalculates the growth prospects of these companies, or if there is a recession which hits their growth numbers, or heaven forbid, if there is some regulatory action to break up these companies to increase competitive pressures, then there could be a very significant and very sudden downgrading of their share prices. This would help to return the concentration of the index to a more normal range, but it would also hammer the share portfolios of anyone who is invested in an S&P 500 index fund, where 40% of their capital has been allocated to just 7 mega-cap companies. The next question you may ask is there a better opportunity than an S&P 500 index for a passive investor? Well, probably not. As long as you're only investing money for the long term, and you have diversity of vintage by investing a small amount of money each month, every month for a period of years, you probably won't find a better way of generating a similarly high risk-adjusted return. However, given what we know about this correlation, and the possibility of a large correction at some point, it may well be worthwhile to have some cash on the sidelines so that you can buy the dip, should it come to that. Well, that's all for this week. Thank you for joining me, and I hope to see you again next time.